Okay, I think we'll get started. First off, my name is Kevin DeSano from Beacon Point. Welcome everyone to our February 2022 Macro and Markets. This is the first Macro and Markets presentation of the year. Those of you that are regulars on our Macro and Markets webcasts know that Michael Dow, our Chief Investment Officer, always comes with a lot of great information, and no time better than right now to get some wisdom and insights. I know you're tuning in to make some sense of what's going on in the market, and that's what we're here to help you with today. Before we get started, just want to do a few housekeeping items. If you're participating via the web and you can see the Zoom screen and you're not just listening to the audio, you can adjust the view up top, but most importantly at the bottom with the chat. If you have questions, send those in to us. We'll be monitoring the questions that are coming in. I'll interject periodically with any items, or if I see some common themes, and we'll get Michael's insights on those. We set the time and duration for this call today to be about 90 minutes. We find that we get a lot of questions and interaction with all of you, and we wanted to make sure that we had enough time to cover those in the course of the conversation today. If you joined us in November, the topic in November was peaks. Peak fiscal and monetary stimulus, peak earnings, peak markets. And today the topic is going to be late cycle dynamics. And Michael's going to talk a lot about what that means, what are the implications to portfolios, and how we're positioning client portfolios in with respect to late cycle dynamics. So I'm really pleased and honored to be a part of the team that has Michael Dow on it. Michael is a wonderful Chief Investment Officer. He's got a lot of great information on what's going on in the markets. And so with that, Michael, thank you for joining us.
Thank you very much, Kevin. Great introduction. Thank you for that. This is best, I think, for our clients and participants on the call if it is more of a discussion as opposed to a lecture. So Kevin will be here to moderate. Please don't hesitate to send your questions in during the presentation. He'll collect them and make sure that we address your questions. This is really your time, and your questions are what we want to try to address. I'll try to answer some of them without prompting by reviewing first our secular thesis. And again, for those of you that have tuned in the past, you'll know that the secular thesis is described as a period of financial repression. We wrote a paper in the research department. Now it'll be 2 years in June, entitled "Investing in the Age of Financial Repression." And I'm pleased to say that the thesis that we put forward back in the summer of 2020 has played out as expected. But we're still in that. We're still in a period of financial repression, which I'll define and talk about how long or where we are potentially and how long it will take to get through a period of financial repression. But we are moving through the business cycle. And that's the topic of today's discussion. As Kevin mentioned, I spoke about peaks in November. And once you reach the peak of the business cycle, you move into the late cycle. And there are things we can identify that can place us there, either with high degree of confidence or less confidence. Doesn't mean we have to stay there or continue towards contraction just because we're in the late cycle. The Federal Reserve has engineered an extension of the mid-cycle and late cycles a number of times in the last 10 or 12 years using monetary policy. But my contention today, and what we determined in the office of the CIO, is that perhaps the Federal Reserve's ability to stretch the business cycle is somewhat limited in the current environment, and I'll explain why. There are market implications. If you are in the late cycle, asset prices behave differently because of the growth and inflation dynamics that are part and parcel of the late cycle. And last but not least, in fact, it's the most important thing. We could talk about macroeconomics, but it's really all about achieving your investment objectives. So we'll go into some detail on how we position the portfolio to respond to late cycle dynamics. So let me begin with a summary of the outlook. And in fact, on the next slide, I'll even go right to the conclusion. That is how we're positioning portfolios, and everything that follows in the presentation today will be part of the framework that we're establishing here in terms of the cycle and the portfolio as it currently stands, and how we position over the last 3 weeks since our last macro and asset allocation meetings that we hold quarterly at Beacon Pointe. So first and foremost, the secular theme of financial repression remains, and the cyclical theme of inflation, rates, and rotation also seems to be holding true. But if I were to describe where we are now in terms of a cyclical theme, it might actually be moving swiftly to the late cycle. Where did we come up with financial repression, and what does it mean, and how did it evolve? And the answer is stimulative fiscal and accommodative monetary policy used to fight the COVID recession of the first and second quarter. It actually happened over 2 months, April and May. April and May of 2020 are the sum total of the last recession we had here in the United States, the shortest on record. And it was short and the recovery swift because of all of the bond issuance and fiscal policy that was brought to bear, and because the Federal Reserve brought the full weight of their balance sheet and interest rate policies to bear to support the economy. And it is that snapback recovery that we're enjoying currently, but it's the aftermath of the stimulative fiscal policy and accommodative monetary policy that we're dealing with now. What does it mean? Stimulative fiscal policy and accommodative monetary policy have led to high government debt and much higher inflation than we've seen at any point in the last 40 years. If you do have a high level of government debt, you can work off the real debt burden using policies that repress nominal interest rates. And if you're the US government, you have control not only of the issuance of the debt, but because the Federal Reserve is an independent, for sure, but it is an arm of the US government. And the Fed does control short-term interest rates, and by default then, and implicitly, interest rates across the yield curve. You can repress nominal interest rates using both interest rate policy and the policy of quantitative easing. It is the repression of these interest rates that we call financial repression. It's not a new phenomena. It's something we experienced and was implemented here in the United States in the post-World War II period in order to work down the debt load that resulted in the post-World War II period. So we are in a period of financial repression. It's something we've seen before, both in the United States in the 40s and 50s, and also in Japan in the 90s and not. So financial repression is not new. What we're moving towards now is a part of the cycle, the part of the business cycle that we refer to as the late cycle. And it's a function of a couple of things. The fact that the Fed is in transition has caused volatility in equity markets and bond markets to increase. And we'll dig in quite a bit to these new developments and how they affect our view of not just the investment environment, but how we're positioning portfolios. So overall, when you have a macro environment that can be characterized as late cycle, there's probably a few things that you can identify as being milestones and things that you're going to need to react to. So our reaction to late cycle dynamics, and again, starting with the conclusion, is that overall we're neutral risk now. When the uncertainty of a transition in monetary policy and a transition from one phase of the business cycle to another is evident to the market, volatility increases, and that argues for staying closer to your strategic allocation. So if you're a 70-30 investor, what that means is your portfolio will position at Beacon Pointe, if you're in one of our strategy portfolios, with 70% growth assets and 70% stability assets. That's what it means to be closer to home. And in fact, considering in prior quarters and ever since the great financial, or not the financial crisis, but ever since the COVID market drawdown in February and March of 2020, we have been well overweight equities, taking our equity risk down over time, where until we were slightly overweight in the third quarter and fourth quarters of 2021, whereas heading into 2022, we've reduced that exposure to equities in order to get equity neutral. So we are equity neutral. We've reduced interest rate risk in anticipation of higher interest rates, and we retain a bias towards moving particularly fixed income allocations to the place where risk premiums are evident. And that would be in private alternative investments, where you're capturing both asymmetric information risk premiums, and if you lock up the funds for a period of time, you're achieving quite a high return for providing liquidity to the market through the liquidity premium. So overall, this is the conclusion. We are in financial repression and remain so. We're moving from mid-cycle to late cycle, which could take one of two paths, which I'll describe in a minute. And all of that leads you to become a little more, to put you closer to home when it comes to taking investment risk. So Kevin talked about my November, or our November discussion, which was entitled Peaks. Peak GDP, which was a result of peak monetary and fiscal stimulus, peak corporate profit growth, probably peak COVID, but that was perhaps a little bit early. And we talked about how uncertain we were about both the peak of COVID and the peak of inflation. Well, we're still uncertain about the peak of inflation. The signs are hopeful for a peak in COVID, but it's absolutely clear that we've seen peaks in monetary, fiscal policy, and GDP. So this is a quick summary of where we stand from a global growth perspective. On the left chart are the JP Morgan Global Purchasing Manager indices, which are global economic activity indices. When they're above 50, they're in expansion mode. When the indices are below 50, they're in contraction mode. One of the hallmarks of late cycle is still positive economic activity, but declining. So we've seen and are seeing a bit of a rolling over of some of these global activity indicators, which are also highlighted here by country. The entire globe is here on the top line. Green is good. Green means we're in full-on expansion mode. Yellow indicates a move from a mid-cycle to a late cycle that is still positive, but declining. And you can see here, not only are the summary data, which includes the whole world, plus the developed markets here and the emerging markets here and the various constituents below, everybody's flashing yellow now. So global PMIs, still positive, still showing expansion, but they appear to be peaking. One of the things we tend to look at when trying to ascertain where global activity, economic activity is headed is copper. So we call that Dr. Copper. As copper prices rise, they seem to have a high degree of correlation with these global activity indicators that we saw on the prior page, which is the JP Morgan Global Manufacturing PMI. What's happening is the global manufacturing PMI seems to be rolling over while copper is telling you that activity is still expanding. The future for copper and the future for the global economy seems to be more of a slowdown than a reacceleration of or expansion. And you can see the same with oil. Oil prices are being driven in large part by reflation and reopening. There also is a bit of, I think, a geopolitical risk embedded in oil prices, given what's happening in Russia and the Ukraine, and the potential for sanctions to reduce supplies, which is pushing oil prices up. But it's important when you're trying to decide which direction the global economy is headed to take a look at these two commodities in particular, because they can give you clues as to the direction and the speed in which we're moving from one cycle to the next. Another peak, besides peak global activity, peak monetary policy. All central banks around the globe now are seeing more rate hikes than rate cuts. These are the number of rate cuts and rate hikes since the crisis began in March of 2020. So this number used to be 0 rate hikes and 120 rate cuts. Now rate hikes are starting to challenge the rate cuts that we've seen since, which would balance out the accommodation and make policy more neutral. In fact, in the last 3 months, we've seen 10 times as many rate hikes across the globe than we've seen rate cuts. And most of those are occurring in the emerging markets, which is the orange line here was the average emerging market global central bank policy rate, which has now gone from 2.5% to 4.5%. So clearly a tightening in emerging market global central banks. Developed market central banks are starting to pick up the message too that we need to start tightening monetary policy to combat the inflation we're seeing. So even developed central banks, including the Bank of England last week and others, and the Federal Reserve most certainly in March, are raising interest rates in order to fight the inflationary impulse that we've seen. And we saw another inflation print today that was off the chart. So we'll dig into that. So if we're in, this is a business cycle graph, which shows economic growth positive here, negative down here, and the stages, early, mid, late, and recession, and the phases of recovery, expansion, and contraction. So where does the US stand? Well, we put the US right here in the late, mid to early, late cycle. So we feel like the next stage, and that's what we're doing today. We're trying to anticipate where the economy is headed. And we're trying to anticipate where investors are thinking the economy is headed, because that's the way that professional investors do it. Instead of waiting and trying to respond and be reactive, we're trying to be proactive with our views in building portfolios and making forecasts for the global economy. So we're still in the mid-cycle, but are moving, I think, swiftly to late. And what are the highlights of late cycle? They're pretty straightforward. Global growth slowing. We've seen evidence of that. Global inflation high, but we think it will likely moderate sometime in the second half of the year, especially if central banks do what they should do, which is start to withdraw accommodation, raise interest rates, stop buying bonds, and maybe even taper, maybe even reduce the balance sheet, which would be referred to as quantitative tightening. And that's the next step. So here's where we are in terms of the global business cycle. Only China potentially is troughing and maybe rising here and has better growth prospects in 2022 than they did in 2021, whereas the rest of the world seems to be here. So just a real quick summary of what financial repression is. It's the policies that lower the government's cost of borrowing, and that's typically implemented through quantitative easing, which lowers nominal interest rates. And while injecting liquidity into the market, the Fed also tends to inject a little bit higher inflation and inflation expectations. So the combination of lower nominal interest rates and inflation equals negative real interest rates. And if you have lower nominal yields or negative real yields because of the combination of lower nominal and inflation, real yields being simply the subtraction of nominal minus inflation, then that makes for a more manageable national debt. In fact, the fact of the matter is that negative real yields actually turbocharge the reduction of your real debt burden. It's a tried and true policy, as I mentioned. It's where we are, and it's important for the government to do financial repression in the current environment in order to make debt levels manageable. What are the debt levels? Well, this is just the debt to GDP going back to the 40s, where you can see the highest debt to GDP we had since World War II has been in the recent period. So almost 120% debt to GDP. We peaked at probably 126. Our original forecast, based on the amount of fiscal stimulus that we'd anticipated almost 2 years ago now, was for debt to GDP to rise to almost 140%. We revised our estimate last quarter and have revised it again because of the swiftness of the economic recovery. That is, the denominator in the debt to GDP calculation is rising quicker, and that's causing us to recover faster. I don't know exactly when financial repression will end here in the United States, but it seems clear that we need to get below 100% debt to GDP. And our forecast is to get there probably sooner than 2030, somewhere on the order of maybe 2028 or so. But even between now and then, that's a long time for interest rates to be repressed. Not as long as the last time we saw financial repression, which occurred from 1942 to early 1960s, where debt to GDP went from 120 to 60%. We don't have to go there. We have to go below 100, and it is at that point that the Fed and the Treasury will either stop colluding on interest rates, or some other policies will be implemented, freeing up the Fed to pursue independent monetary policy. Just really quick, the hallmark of financial repression is negative real interest rates. Repress nominal, let inflation run hot, and you get negative real interest rates. Here's the last 20 years of negative real interest rates, or of real interest rates. They've been negative a couple of times. For 4 or 5 quarters back in 2012 and 2013, we had a period of negative real interest rates. We just feel like this one is more persistent. And in fact, they were 20 basis points lower, 30 basis points lower in the more recent experience than they ever got back in 2013. But we're back up to now a negative 49 basis points. All this means is if you buy a 10-year Treasury today, you're guaranteed to lose almost 50 basis points of purchasing power every year on year for the next 10 years. So negative real interest rates make both Treasury and safe yields unattractive from a purchasing power perspective. There's not a yield out there until you get to 30-year yields that is anywhere near positive when it comes to the Treasury market. Let's stop there. If there are any questions, Kevin, that have come in on any topics of interest, then I'd be happy to take them. Otherwise, we'll move into the meat of the presentation, late cycle dynamics.
One question that came in, which I think is actually a very interesting one, is this period at all comparable to the 1970s with the inflationary environment and what the government is doing to fight all of that? And again, if before you answer that, for those of you that have questions, the Q&A box at the bottom of your screen, just type those questions in, and we'll monitor those and get those out to Michael when it's appropriate. So, Michael, 1970s, is this the same?
No, I don't believe so. There's a lot of things that have changed dramatically since the 70s. And we did a deep dive into this issue at our macroeconomic meeting back in the fourth quarter in October of 2021, because that question has come up. The similarities are obvious. Oil prices are up and inflation is up. But the structure of the US economy today is completely different. And what I would call the economy's beta to oil prices is much reduced. Oil was the main driver of economic activity back in the 70s. So higher oil prices and an oil price shock, a supply shock, which is similar to what we're seeing now as a supply shock across an input, was much more impactful. So that is different. And the structure of the economy is different, and hence the response of the economy will be different. And the other thing is the Fed, I think, has learned from the past, and monetary policy is much more effective in dealing with inflation since the 70s, and since Paul Volcker began the war on inflation, actually on October 6th, 1979, and used two recessions in the early 80s to wring inflation and inflationary expectations out of the economy. So the Fed has created an incredibly credible inflation fighting dynamic, and they're not going to lose it in the current environment. That is, they're not going to hesitate like Burns, the chairman back in the 70s, did when he was subject to political pressure. The Fed is going to act independently, and they're going to raise interest rates to maintain their inflation fighting credibility, which may mean we have an economic slowdown sooner rather than later, but it will also mean that we don't have a decade of higher inflation that causes a myriad of distortions in the economy. So no, I don't think we're the spot.
Okay, that's awesome. And then the only other question that came in, which we talk a lot about, the headlines creating a lot of uncertainty in the market, with the headlines talking about peak equity market valuations. Is the market ripe for a correction, or are those headlines and all of that stuff we read and see on TV overstated a little bit?
And I hate to put that question off, because it is a question I'm sure others have, but we'll go into equity market valuation and where the Fed's monetary policy has taken us and where we might be headed in upcoming slides. So let me defer, but the answer to the question, to at least address that head on, is we're more likely to have a correction now than we were at any time in the last 2 years, because of the recent excellent performance and the fact that the Fed may think that investors are kind of playing with the house's money a bit. And because inflation is so high, their degrees of freedom are somewhat constrained. So we'll get to that in a lot of detail in upcoming slides. So hold that thought, Kevin.
One follow-up question was the Fed now has the dual mandate, whereas Volcker didn't in the 70s and 80s. So
no, they did as well. Humphrey Hawkins and the bill and in effect, the dual mandate has been in place since Humphrey Hawkins. So which is a legislation that goes way back. So the Fed has always had the conflicting dual mandate of maximum employment and stable prices in our investment careers, plus another 20 or 30 years. So, and they have always reacted to higher inflation by attempting to throw people out of work effectively. This is some people would call it collateral damage to try to slow the economy and take the steam out of rising prices. But frankly, those two things are part and parcel. It is the Fed's unstated goal during periods of higher inflation to raise the unemployment rate. because it is that and that alone which will take the pressure off of wages, which are the things that the Fed fears the most, because wages are persistent and they tend to set off a price spiral, a wage price spiral, that by increasing wages allows for consumers to pay more, and hence businesses feel like they have pricing power. And because businesses are running their businesses on expectations of what they can charge for their goods, they have more confidence that they can raise them if their counterparts and the competitors are raising prices as well, and that gives them higher margins to then pay workers more. So a wage price spiral is what the Fed fears the most, which is why they used to basically run monetary policy using the Phillips curve, which is another way of saying lower unemployment equals higher inflation, higher unemployment or less employment, less labor market, less supply in the labor market equals lower inflation. So that's how they've run the Fed since the 60s or the 70s, since the Phillips curve was adopted as their primary reaction function. But we digress. We'll talk more about that as we get into the inflation situation and as we talk about labor and where we are in the cycle. Growth moderating is part and parcel of the Fed becoming more contractionary. And contractionary monetary policy, which is what we expect to see sooner rather than later. Today, after the CPI inflation print, it became about a 50-50 proposition that the Fed would raise interest rates by 50 basis points in March. And we haven't seen a 50 basis point rate hike from any developed central bank since 2002. And we haven't seen a 50 basis point rate hike from the Fed since 2000. So that would be quite something. And if the Fed can continue to nudge the communication and the market higher, I think the probabilities will increase that we'll see a 50 basis point rate hike to start us off, which would be quite something. But that's clearly consistent with late cycle dynamics. Growth is moderating, credit conditions are tightening, earnings may become under pressure, although they're still very positive, very strong earnings growth, but not what we saw 9 months ago. And policy becoming contractionary is your number one signal that we're moving from mid to late cycle. And the problem with mid to late cycle transitions is you don't know if the mid cycle is going to transition and accelerate quickly into late cycle dynamics, where you would have a contraction either late 2022 or sometime in 2023, or can the Fed do what they did for 10 years, which is engineer an extension of the late cycle, make it last a long time, returning to mid-cycle dynamics where growth is maybe rising again and policy becomes neutral sometime later in 2022 if they do the job correctly and swiftly and aggressively in the first half of 2022. There might be some pain in the first half, but if we can get to a neutral monetary policy, we may be able to extend the expansion without a recession, which would be the gray probabilities here. And so that's potentially likely too. So just to put a fine point on what late cycle means, peak economic activity, which is a result of peak fiscal and monetary policy support. I don't have to talk much about higher inflation. We're all pretty much aware of the supply chain disruptions and the labor market dysfunction, which has caused wages, rents, and goods prices to rise. And clearly, and we haven't started yet because we're still 5 weeks away from the next Fed meeting, but we are going to get a federal funds rate hike, whether it's 25 or with 100% certain, well, okay, 99 and 44/100% certainty, a 25 basis point rate hike. And something I've been talking about with our team for the last 4 or 5 weeks is that there's a pretty good chance of a 50 basis point rate hike. I just think that that's what they should do to set the tone. A little shock and awe might not be a bad thing. It would take some of the wind out of the equity markets, but it would set us on track for a longer mid-cycle expansion as opposed to a recession. But the key feature, and this was a question that was asked earlier about compensation for risk and whether valuations are high and what the Federal Reserve's reversal of accommodative monetary policy might mean for the equity market. There's clearly evidence that there is less compensation for risk out there. And that just is a function of the fact that you've had excellent capital market returns. For the last 3 years, you've averaged about 24% annualized returns, 2019, 2020, 2021, the 3 best years since the late 90s. So that doesn't come for free. We're pulling, I think, good capital market returns forward because of all of the accommodation and the stimulus that we've seen in the last 18 to 22 months. So that's the key feature here. Great recent returns set the stage for moderating future returns. And the compensation that's available, either as expressed in the equity risk premium or in corporate bond spreads or in real yields, is clearly low. So this is the thing that we're going to have to deal with going forward. Let me provide some evidence for the reduction in fiscal stimulus. This is a projection of fiscal drag. And we're going to see the mother of all fiscal tightenings in 2022. That is the difference in the primary deficit to GDP, which is the deficit spending we saw in 2021 versus the deficit spending that we're going to see in 2022 is an excellent indicator of whether you have fiscal impulse or you have a fiscal drag. And we're seeing the biggest change in the primary deficit from one year to the next in 50 years, 70 years, since World War II, since 46, I think, maybe 47. So fiscal drag is going to dampen economic activity for sure, and will not provide the same impulse that it has for the last 2 years. Even if you get some more of the either Build Back Better, which is not likely, or pieces of Build Back Better, it doesn't matter. The difference between the fiscal drag in the current legislative environment in 2022 or the fiscal drag, if you include bits and pieces of Build Back Better, because Build Back Better stretches out over 10 years, the impact in any 1 year is de minimis in terms of the change in the primary deficit. So just to put a fine point on it, no matter what happens from a fiscal legislative perspective, we're going to see a massive amount of fiscal tightening. It's the largest since 1947. What was the other piece? Monetary policy. Well, we've just talked about the fact that there are now five rate hikes expected in the next 12 months from zero just a couple of months ago. 5.5 rate hikes this is what the market is expecting in the Fed funds futures market, which is an excellent indicator of what the market believes today. May not be totally predictive, but clearly the market wants rate hikes more than they have at any other point in the recent cycle. The other thing, of course, is the Fed's balance sheet. This is the total assets going back to the great financial crisis, when the balance sheet went from about $1 trillion to $4.5 trillion. There was some normalization here, but this is, of course, the aftermath of the COVID recession. And this is a forecast going forward. So here's where we are today at 8.8 trillion. We're probably peaking at 9 or just under 9 trillion, but the steady state for the balance sheet is likely, if you just draw a line like this, looks to be closer to 6 trillion. The balance sheet should grow about the same rate as the economy, but this is actually a little faster. So 6 trillion, that's a lot of tightening that needs to come. And if that's the case, then the things that have caused the tailwind to economic activity, and hence the equity market and other risk assets, it is being removed. So not as much zero fiscal stimulus. A reduction in monetary policy stimulus equals a lower economic growth outlook. And that's late cycle dynamic. I like this chart a lot. There's a lot of information going on here. This is the Fed's preferred inflation metric. It's the personal consumption expenditure deflator, or PCE core deflator. This is what the Fed looks at to try to target 2%. The Fed wants the PCE core to be 2%. As you can see, for most of the period from 1998 until 2021, the PCE deflator was much below the Fed's target. Anytime you see the green arrow, the green here pointing down, that suggests that they have not come close to their inflation target. Well, PCE is now closer to 4.7% than anything else. The Fed is going to raise rates in March because this number is so much higher than their 2% target, that if they're going to use a 3-year average, and this is our estimate of what average inflation targeting means. It means the average of the last 3 years has got to be plus the average of the next 3 years has to be 2%. So the average of the last 3 years is now finally over 2% because of the recent spike. So they've got to start raising rates because they can't allow this to get embedded. So to get to their average PCE of 2%, the next 3 years of inflation, the PCE has to be below 2% at 1.94. This is why the Fed is going to raise rates in March. They can't allow this to get too far out of hand, or their new policy framework of average inflation targeting becomes nonsensical. Let's talk about the economy real quick. We'll be through the late cycle dynamics, and I want to talk about the equity markets. Changes in lending standards, very reminiscent of late cycle dynamics, is a tightening of credit standards. More banks are tightening lending standards in the current quarter. This is actually a lagging indicator. It's going to be higher. And this is just forecast for GDP going out the next 6 or 8 quarters from the 7% we saw in the fourth quarter of 2021 back down to something like 2%. So again, tightening growth, lower credit, late cycle dynamics. Let's talk about inflation. It's on everybody's mind. So for those that have tuned in, this is a pretty common, I've shown this chart now. It used to be tilted the other way where disinflationary forces were outweighing inflationary forces. But since last summer, the teeter-totter has moved in favor of the forces of inflation, which would include accommodative monetary policy, the fact that the Fed has changed their policy framework to be more dovish, and all these other things that are either problematic, cost push, which are transitory, or demand pull. Demand pull inflation is driven by growth in the monetary base, which is quantitative easing, and by a reduction in the output gap or decreased slack in the economy. Clearly, the economy is in many cases running hot now because of mismatches in the labor market and goods markets causing prices to rise dramatically. So this is the framework. We're looking at inflation drivers, whether they're persistent or transitory. In many cases depends on whether they're cost push or demand pull. Some of these are short-term disruptors. Some of these are longer-term forces. But we've really coalesced in our group around the fact that inflation was going to be a lot more persistent than the Fed was talking about 9 months ago when they started to use the word transitory. In large part because it seems to be leaking into more persistent types of inflation. I'll get to that on the slide after this, but just to see where we are today, I updated the slide this morning. The most recent CPI number came out today at 7.5%, the core CPI 6%. These are the highest numbers in 40 years. Very alarming to the Fed. But there's other things that the Fed is looking at besides today's inflation. Actual inflation today is in the danger zone, but inflation expectations for the future are really what matters to the Fed. So they're aware of this, but this is the metric that they're really focused on, which is inflation expectations. This is the 5-year break-even inflation that's embedded in TIPS prices today. So longer-term inflation expectations are currently anchored. This is actual, actual PCE, which corresponds to actual CPI numbers. This is the one the Fed cares about. They still believe this is going to roll over in the second half. I think that's probably true. It's really going to be hard to see a 5% PCE inflation 6 months from now just because of the comparisons. They start to get very dramatic. But this is the number the Fed cares about. As long as inflation expectations remain with a 2 handle, something with 2% on it, I think that they'll be reasonably happy, although they would much rather see this number be below 2.5% for longer term inflation. So that's why they're going to raise rates. This is not in a danger zone. This is in the yellow, but it's really about inflation expectations that they're focused on. Again, these are also updated. I've got 2 charts coming up real quick on inflation. This is the year over year by component, and the next one is month over month. Year over year tells you what you need to know about changes in the last 12 months. Month over month tells you about the momentum in those changes. So we've split up the components of the CPI release and added wages, average hourly earnings here, into persistent and possibly transitory. So the possibly transitory stuff is the stuff that's really running hot. These are lagging, they're larger components of inflation, and they have a tendency to be more persistent. So I've included the Fed's 2% target. Clearly, rents are up, owner's equivalent rent, which is a function of house prices, CPI shelter, et cetera, and then average hourly earnings, which is wages. Wages and rents are the prices that the Fed cares more about because they have a tendency to get embedded in the economy. Fed's going to raise rates in March. Unless there's some kind of an exogenous shock that we're not aware of. But these numbers are, perhaps, transitory in that they're related to the reopening. So clearly inflation is high. 7.5% is a scary number. Here's the momentum in those numbers. The momentum for wages and rents remains meaningful. So persistent prices are continuing to rise given the month-over-month data, but there's some deceleration in the reopening trade prices in terms of the leisure-related, hotels and car rentals seem to be declining, but that's 1 month's data. So there's just no relief in today's data. In fact, caused a fairly large increase in the probability of, as I mentioned earlier, a 50 basis point rate cut in March. So no relief in the month-over-month data. I'd like to look at one other inflation series because I think it's important. It's the productivity adjusted wage inflation. Just to put a fine point on it, wages can rise, but if productivity is rising with it, then it's not inflationary. So you can't just look at wages and say the Fed's in trouble. The Fed looks at productivity adjusted wages. The trend, unfortunately, in productivity adjusted wages, because productivity is not keeping pace with inflation, is high. So again, evidence that the Fed is going to hike rates and maybe even hike them 50 basis points. What's going to take the pressure off of wages? Well, the January employment number saw some relief in that metric, which would be labor force participation. If labor force participation recovers back to levels we saw in February of 2020, clearly that means millions of more people back into the labor market. And that will result in this reduction of the mismatch in terms of the demand for labor and the supply of labor. And if you get that, obviously wages have a tendency to moderate in that environment. So we need to continue to see an improvement in people coming back from the great retirement, which I'm not sure there was a great retirement. There was a great sabbatical, maybe, in that people take 6 or 12 months off, but everyone's going to have to go to work at some point that isn't independently wealthy. And if we get a hit to the stock market or if house prices start to cool off, then I think people will feel less wealthy and go back to work. So I'm for a recovery in the labor force participation rate because the U.S. economy just doesn't, change structurally on a dime. So it's likely that we'll see some more recovery, which will take some of the pressure off of wages. If there needed to be more evidence to suggest that the Fed is going to raise rates, it has to be here. So I mentioned earlier, this is the outlook for Fed rate hikes, but here's why. The Fed policy rate deflated by inflation, that is the real Fed funds. Real Fed funds tells you how loose or tight policy is. Policy has never been this loose. They have massive degrees of freedom to raise interest rates here because policy is as loose as it's ever been in the history of the Fed. So they're going to raise rates in March because they can and they should, because monetary policy at nearly minus 5% is the loosest on record. Okay, so if there are macro questions, I'll take them, Kevin. If not, I've got a couple of slides on compensation for risk, just to put a bow on the late cycle dynamics before we move into the implications for markets.
The only macro questions that came in were regarding interest rates with the global rates at or near zero. What are the implications of that on keeping US rates lower? And is there a possibility for a soft landing in the economic cycle? Or are we risking moving into a recessionary period? So those are the two macro questions that have come.
The global rates question is easy. The global yields have always provided an anchor to US rates, and they will continue to do so. They're rising as well, but not as fast as US Treasuries. US Treasuries 10-year yields look cheap now on a hedge, an FX hedge adjusted basis versus other rates. That is, if you have a choice between investing in either German 10-year yields or Japanese 10-year yields, and you currency hedge them, the 10 years look really cheap at 2%. And as I mentioned, US Treasury 10 years hit 10% today. So US Treasury 10-year yields can't rise indefinitely with lower global sovereign yields because we're in a world of international global markets. So it's a good question, and they've provided an anchor to 10 years for a long time. They get out of whack every once in a while when there's a revaluation of where 10s are going based on inflation here in the US or Fed policy, but they'll adjust. So 10-year yields can't go to 4% or 3% anytime soon with German 10-year yields at zero or still negative. So it's not, that will remain a feature of global interest rates and something that I've watched for most of my career. In terms of a soft landing, it's just really tough to engineer that because the economy has about 1,000 different dials and you just don't know which one to turn. And the Fed only has a sledgehammer interest rates to do that. It's very difficult. It's possible. They've engineered a soft landing for 10 years, but at what price? And I think things are different now, which I'll talk about in a second. And it relates to the ability of the Fed to respond to an equity market decline, given how inflation has risen so dramatically. They need to raise interest rates, and they're got their fingers crossed that they don't have an equity market decline that causes them to respond and to affect the Fed put. And I'll talk about what the Fed put is. It's basically the Fed put is policy measures that ease during periods of equity market downturns. It's basically the reason you would buy the dips is because the Fed put is in place. And we'll talk about that in a sec. But let me just suggest that in terms of equity markets, there's okay compensation for risk in the equity market, but if 10-year yields rise a lot more, another 50 basis points or so, it will make the equity market look a little more rich than it is right now. In fact, the way we've put this together here is that when the equity market, the risk premium is high, that you have high compensation for risk up here during periods like the immediate aftermath of the global financial crisis, or in March of 2020, the equity risk premium was very high. You were getting a lot of compensation for risk. Now this is the 20-year average equity risk premium. We're at 3% now. We're 20-year average is 3.4. One standard deviation is only 30. Well, let's see, it's about 40 or 50 basis points or 60 basis points below. So, we've got some room to maneuver here. But if interest rates rise dramatically, and this is the equity, this is the earnings yield deflated by 10-year yield. So if 10-year yields rise, clearly the risk premium will decline, and you'll be offered even less compensation for risk. So the equity risk premium deflated by 10-year yields doesn't say stocks are cheap, says they're fair to rich. But if you look at the real equity risk premium, which is unfortunately being currently distorted by massive inflation, high inflation is pushing the real equity premium well below, and a couple of standard deviations briefly, or 2 standard deviations below the average when we saw the recent spike in inflation. So it's likely that and we're seeing it now, that the equity risk premium is recovering because 5-year break-even inflation is starting to moderate. That is, the expectations for future inflation are moderating. So this is in the real equity risk premium. Another valuation metric is showing lower compensation for risk. What about corporate credit? That is, corporate bonds or municipal bonds here in the U.S. Very low compensation for risk. This is just the last 7 years, but the longer term history suggests that high yield spreads well below the average, or were. January was the worst month in 20 years, and well, not 20 years. It was in the top 5 of the worst months of the last 25 years anyway. For credit spreads blew out. This is just the option adjusted spread. The option adjusted spread in your corporate bond is your compensation for default risk. And the compensation for taking default risk was bumping along at the very lowest levels. We were very enthusiastic about corporate credit back here when compensation was high. And we had an overweight in the portfolios to high yield and to other corporate credit. But as the compensation for risk is being squeezed out, as the spreads tighten, well, right about here, we ended our high yield exposure in the summer of 2021. And investment grade credit is also bottomed and started to rise again. But just to put a fine point on the late cycle dynamics are low compensation for risk. And there's clearly low compensation for risk in both equity and credit markets. And this is just another metric to indicate that is real yield. There's some positive real yield, but you have to go to high yields. So again, low compensation for risk would be these low real yields that are being on offer because inflation expectations are so high. Just to put a fine point on reading this chart, current inflation, 5-year inflation expectations are 2.8%. The market's telling you inflation is going to be 2.8 for the next 5 years. If you have, a single A municipal bond yielding 1.8, you subtract the 2.8 from it, it's almost 1% of negative real yield. So it doesn't look great if you're trying to find a compensation in either the municipal or the corporate bond market. So that wraps up the late cycle discussion and the financial repression discussion and global growth. This is probably the more important piece. What does it mean for markets? And Kevin, if there's no questions, I'll dive right in.
We had one more question come in. 18 billion commercial bank deposits at all-time highs and growing, according to Fred. Recently reducing the equity exposure seems to be going with the masses. At what point do the masses realize their losses in purchasing power? And what asset classes do we see the monies fleeing to upon this realization?
So there's something called money illusion, which has kept, I think, most market participants from thinking about real yields. We have been on the horn and blaring the horn about real yields being the most important thing for clients, because you eat real yields. You don't eat nominal yields 10 years from now. But the fact is, the vast majority of investors don't really focus on it. Money illusion is a feature of the economic literature going back to Fisher, 75 or 80 years ago, or now 100 years ago, where he basically said, most people don't think about inflation when they're making investment decisions. And that's true today as well. So the realization isn't going to come, I don't think, because most advisors won't talk about it. But for me, it's the most important thing for our clients. So we're gonna talk about it, and we've done things to protect the portfolio. I'll talk about a trade we put on and actually took off, which may seem counterintuitive. We took the TIPS trade off. So we had an allocation to TIPS going back to August or September of 2020, when inflation expectations were very low. The time to own TIPS is when inflation expectations are low. The time to sell them is when inflation expectations are peaking and maybe rolling over. So I could talk a little bit about that, but I don't anticipate there being a wave of realization that that negative real yields are horrible across the average investor base. It's certainly something that we've been talking about with clients for quite some time.
Okay.
What's the biggest implication of late cycle dynamics in the marketplace? Higher volatility. It's rising quickly. The orange line is bond market volatility. As yields rise, as bond prices sell off, volatility increases, and increase in volatility is another way of saying there's a lot of uncertainty about where monetary policy is headed. And as volatility increases and uncertainty increases, your compensation for risk has to increase. So for compensation for risk to increase, prices have to adjust lower. And once they've adjusted lower, the compensation for risk is then maybe adequate, but it's the journey from low compensation to higher compensation for risk that's quite painful for both equity and bond investors. And we should expect to see that as volatility rises. So you've got equity market volatility, which is the VIX index from the CBOE in the blue. And the key thing about the VIX is you're starting to see higher highs as inflation, as equity market volatility starts to spike, which it does, and you're seeing higher highs, the trend seems to be higher. So implication number one of late cycle dynamics, higher volatility. Implication number two, higher interest rates as monetary policy becomes less accommodative. But I want to put the higher rates into context, and many of you have seen this slide before. It's 230 years of interest rate data. It goes back to the 1790s when US Treasuries were first issued. The average 10-year yield for 230 years is almost 5%, peaked at 14% back in the early 80s. So this is the entire history of 10-year yields. This is the last 18 months or 20 months now. And this orange square and this orange square are the same period. So the recent rise that we've seen in rates up to 2% is really kind of a bug on a windshield in terms of the greater history. On the other hand, it's important because it's up fourfold from the absolute all-time low, which occurred back in August of 2020 at 51 basis points. And we've basically been in a range of 175 to 125 since then until today, when we broke out, and now we're above 2% and probably headed for 2.25, but maybe not. Rates are up 140 basis points from the low, but 140 basis points in the grand scheme of things. I just want to make sure everyone's aware. We're still at very, very low historically interest rates. Here are the two charts that I want to spend some time on because they basically tell you everything that I'm and our team, Julian, Derek, Jason, Stephen Marshall, and Gabe, we're talking about in the office of the CIO, and that's this. Here are equity prices in two periods. On the left is equity prices for the last 17 years. On the right is for the last 20 months, almost 2 years now. And the drawdowns and Fed funds rates. The important things to note, since the great financial crisis, when stocks were down 42%, equity markets are up not quite sixfold, with two major hiccups. And the two hiccups have occurred in the fourth quarter of 2018 and the first quarter of 2020. The Fed funds rate responded when there was an equity market drawdown. Since the COVID recession and the COVID bear market, which lasted about a cup of coffee, we've seen smaller drawdowns and continued quantitative easing and monetary policy easing from the Fed. And as a result, we've had a fairly steady and frankly, frighteningly steep rise in equity prices. And I mean frighteningly steep because anything that goes up like this is something that I want to take a closer look at. I'm not saying equity prices are going to decline dramatically, but we're probably due, and I'll show you a slide that suggests that. But I mentioned earlier something called the Fed put. Every time the equity market declined, the Fed moved in and either lowered interest rates, or on the next slide, I'll show you implemented quantitative easing. For this entire period, the Fed has implemented quantitative easing and would either adjust purchases or never reduce in response to an equity market drawdown. And every single time we had a 5 or 7% drawdown in the last 2 years, the Fed was perceived to be willing and able to step in. So dip buying was rewarded. The problem was it's been in this period here, and we saw a -10 drawdown, -12% intraday, -10 at the daily close. This has come now with inflation 3 times the 15-year average. So the Fed has a lot of degrees of freedom to accommodate equity market declines when inflation is low. The Fed's degrees of freedom have been greatly reduced. So let me just say this: the Fed put, which by the way, just to put a fine point on it, is policy easing after large U.S. market declines. The stock market declines. The Fed put suggests that there's a level somewhere, a strike price of the put, where the Fed is most assuredly going to step in. Investors have taken that to heart. It's a moral hazard, but that's what they've done. And it means buying the dips is a smart investment strategy. And it has worked well. If you'd bought all the dips since 2009, well, you'd be up 600%. That's great. Let me suggest that that was partly due to the fact that the Fed put was set at a lower level, that is, call it down 15 or 20% for sure, because inflation didn't constrain their ability to loosen monetary policy extensively enough to put a stop to the downdraft in equity prices. So moving on to this slide, again, Fed funds rate in the black line here, showing the zero equity effective lower bound for much of this period. QEs are shown in green, QE1 through QE 2020, with a little bit of sliver QE2 or 3, which came after Operation Twist included. But what you can see here is that inflation, again, averaged 2.1% during this period, and inflation is now 7.5%. If you just took the equity market line, and I'm not a technical analyst, not saying this is the only thing you need to know, but if you just took a line and drew it from effectively the bottom of the great financial crisis and put it on trend, we'd be at 38, 37. This rise here seems engineered almost exclusively through monetary policy to get to 4,700 on the S&P. Did the Fed respond to this at -20%? No, they didn't. They talked about things. They talked on January 4th, 2020. There was a meeting at the Atlanta Fed with Bernanke, Powell, and Bernanke, Powell, and Janet Yellen were all at the same Atlanta Fed Economics Club meeting, where they talked about being more accommodative, but they didn't do anything about it until the third quarter of 2019. So the Fed, at least at this point, was unwilling to support the market down 20. When the market was down 30, boom, QE 2020. Where will the Fed intervene now? I don't know. But I will say this, probably at a lower level than 20%. Why? Because that just takes us back to the trend line. Certainly at 30%, but I'm suggesting that the risk in the equity market is perhaps higher now. That is the point where the Fed is willing to provide accommodative policy is probably lower for two reasons. One, because we've had such excellent recent returns, going down 30% only takes us back to the middle of 2020, just FYI. Going down 40% just takes us back to 2019 levels. And I think the Fed is looking at that and saying the investors are in some respects playing with the house's money. And that they're going to look at this trend line and they're going to note for the record that inflation is too high for them to ease policy right now. So the risks to the equity market, I think, have increased with recent excellent performance and with the spike in inflation. So the Fed put is lower, which means the risk is higher. That would be my contention. That's my conclusion. It's our team's conclusion from this slide. It's not everybody's conclusion. And if the Fed can engineer a soft landing and extend the mid-cycle, it doesn't mean we can't stay at 4,700 or go to 5,200. Doesn't mean we're going to 3,400 anytime soon. But the portfolios are built for now neutral equity risk, which means if we'll perform in line with equity markets, we won't underperform, presumably, if the equity markets sell off. This is why I think we're probably due for maybe some consolidation in equity prices. This is S&P 500 annual returns and drawdowns going back for 40 years. And what you can see here is that we get a minus 17. This is the minus 17% line. I picked that arbitrarily. About 1/3 of the time. So every third year or so, on average, we've gotten a minus 17%. We got our minus 10 in January, but still, that doesn't really cut it. So large drawdowns should be expected. Most years end positively. So I'll make some comments about if I'm sounding negative on the equity markets. I'm not. In the long run, I'm cautious in the near term. I am bullish in the long run if you've got a portfolio that's properly set up for risk. And risk doesn't mean your risk in the short-term 17% drawdown. Risk means achieving your investment objectives over 10 years, which demands that you be involved in the equity market. And I would say this, until somebody can tell me exactly when the peak is and exactly when the bottom is, and anybody that can do that is doing it for themselves, and they're not going to tell us, and they've become fabulously wealthy behind the scenes. No one knows that, which is why you have to ride out the volatility. The volatility of the equity market is the price we pay for wealth building, full stop. Embrace that notion, and the recent volatility and the expected future volatility are likely to be better dealt with. So I'm going to talk about portfolios, how we're positioned now, Kevin, unless there's questions that fit into the current discussion.
Those are the majority of the questions that are coming in. Is in light of everything that you've discussed so far, talk about portfolio positioning, equity market risk, why neutral? Maybe we should be a little lower risk with respect to equities, are a few of the questions that have come in. And then in addition to the US equity market, we've gotten some questions around, with all the geopolitical stuff that's going on, is it time now to be taking risk off internationally? What about China and emerging markets? So those are the questions that we've seen so far.
I'll start from the last question first. Emerging markets have been reduced in the portfolio because of China, not because of China-Taiwan risk, but because of China, which I think it's inevitable that there will be, if it's in the U.S. interest to go to war over Taiwan, then we would, but I don't see it. So I don't think we need to, and I don't think we should worry about that too much. I think it's inevitable in the long run. It may not happen in our lifetimes, but it seems reasonable to assume that China would once again become one country. I mean, the Taiwanese think that the mainland is the breakaway, rogue nation, whereas Beijing thinks Taiwan is the recalcitrant partner. They've been, the same country up until 70 years ago, and really, when Taiwan declared independence, I mean, it's been a long time since they were together, the 47 or 51 or so. Same with Ukraine and China and Russia, by the way. Ukraine's been an independent country since 1991, but historically, it's been very closely aligned with Russia. And if it's in the U.S. best interest to protect Ukraine, then we'll do it, either militarily or via sanctions for sure. But I think that's already pretty well priced in as well. So geopolitical risk is on the table, but it's probably only affecting the investment implications because of oil prices and the potential for sanctions on Russia to continue to push oil prices up. In fact, when we talk about risks and opportunities, which is 2 or 3 slides up, I'll try to highlight some of those things. International equities, developed versus US, they're cheap compared to US. And if the US is going to suffer some increasing volatility, which we saw similar to what we saw in January, international developed stocks outperform. So emerging markets have their own, I would call them idiosyncratic issues. That is the new mandate to swing the pendulum back to socialist and policies and communism, where no one can get wealthy in China, is going to be bad for businesses, bad for the Chinese stock market. And Chinese stock market is 40% of EM. So that's why we don't like EM so much, is because of idiosyncratic risk in China, not because of China-Taiwan. International equities like developed, so your IFA index is relatively cheap compared to the US. And as I mentioned, will outperform because the valuation levels are cheaper than the US, which looks stretched. And there's a lot of great companies outside the United States. You can get similar exposure, in the S&P because of, global operations. But from a diversifying perspective and from an achieving your investment objectives, international equities definitely have a place. So, pardon me, while we're reducing them slightly, it's not because of valuations, because the strategic allocations changed for clients when the benchmark changed. And that's why we moved slightly lower in international. EM, we moved down because of investment concerns. International versus US, I think international is likely to have their day in the sun again, perhaps sooner rather than later, because of the valuation, how stretched valuations are in relation to international equity. Was there another question in there that I didn't?
Yep. Well, it's related to how the portfolios are positioned. So I think we can probably answer this as we move through exactly here, which is with all the stuff that you said about equity markets and the volatility and some of the risks there, should we be even less than neutral in terms of our allocation? Well, and then other questions about alternative investments as it relates to rising interest rates and bonds. So both bond alternatives as well as stock market volatility.
Let's cover all the asset classes on this slide. It's a pretty good, I think this addresses every overall risk in terms of growth versus stability assets, neutral. Equity market risk reduced to neutral effectively. Should you go underweight equities? And the answer is not in the beginnings of the late cycle, because we're still in expansion mode. And again, my crystal ball is not that clear. Our ability to time when the next recession comes, which would be the catalyst for a significant drawdown, or expectations for a future recession or corporate profit recession, are the catalyst for the equity market to decline dramatically. We can't pinpoint that. There's absolutely no way to do that. It's not difficult to think of a scenario where we would go underweight equities, but not now, because the information that we have and the way we're synthesizing it doesn't argue for it. Uncertainty, greater uncertainty means get closer to home, and that means neutral. So things could go higher, they could go lower. If the Fed does engineer a soft landing or extends the late cycle out many more quarters, 3 or 4 quarters instead of the 2 or 3 quarters that are maybe typical, then you're likely to see the equity market continue to go higher. And we don't want clients to miss that either. So neutral is the place to be because of the level of uncertainty. Interest rate risk is reduced and has been reduced because we think interest rates are going higher, and the Fed's telling you that. That's going to hurt us if there's a significant drawdown, because the only place to be in interest rates, if there's an equity market crack, is to be long US treasuries and have a lot of what we would call interest rate duration in the portfolios. But we're reducing our interest rate risk because we don't expect that, which again is why we're not underweight equities. We think things are going to muddle along for another quarter or two. And we'll reassess every quarter, as we do during our macroeconomic and asset allocation committee meetings. But as it currently stands, this seems the most appropriate position. So given the uncertainty in public markets, alternative investments are quite attractive, because if the equity risk premium is low and the compensation for credit and rate risk is low because of all the things we discussed earlier, you have to find other risk premiums to capture and turn into returns for your portfolio. What are the risk premiums that are available in alternative investments? There are the asymmetric information risk premium, and there's the liquidity risk premium, both of which seem durable to us. Information asymmetry means alternatives are stuff that not everyone's looking at. That is, there are people doing things in other markets, private equity, private credit, private real estate, that aren't available to public market investors. That's information asymmetry. There are skilled investors who are exploiting the returns that are available in private markets that aren't available to everybody in public markets. That is a durable risk premium. The other one is if you're willing to give up your money for 5, 7, or 10 years, you're getting paid a lot for that, for liquidity provision to the marketplace. So providing liquidity to the market by investing in alternative private limited partnership alternatives, providing or taking advantage of information asymmetries. The reason the blue box is the biggest box isn't just because there's more words in there. It's because it's our best idea right now in a world where public market compensation for risk is low. So in terms of growth and stability assets, that is, we're neutral to the strategic allocation because of the uncertainty, because we want to be somewhat defensive, although interestingly, small caps are enjoying a pretty nice rally here, even in a higher rate environment. In the higher rate environment, that makes sense. In not in a late cycle environment, small caps should do poorly in a late cycle. So we reduce small caps and increase large cap value because that seems like the right valuation move to make. Reducing interest rate risk by going to short duration bond funds is also, I think, will be helpful to client portfolios because they're not exposed to the rate hikes to the same degree. But again, the uncorrelated private sources of risk premiums lead you to hedged equity, private real estate, private credit, and private equity. So stay close to home and find risk premiums that are interesting. Did that get to the majority of that question?
It has, absolutely.
So let me do this. I'm going to go to some slides that might be helpful to answer two questions. We've got some time here. I don't need to go all the way to the 90 minutes if that's if people are. But if people are willing to, if
we also have a few more questions, Michael. Around.
Let's talk about them. Yeah.
So I know we're early in the year with the midterm elections coming up. Now all of the conversations around that are starting to heat up. What are the implications of a transfer of party leadership in government in the fall?
Gridlock would be the answer, I think. It's entirely likely. I mean, the Democrats don't really enjoy a majority in either houses of Congress right now because of the factions within the Democratic Party. You've got 2 senators that are Democrats, but they're from red states. And in the House, you've got the Progressive Caucus and the moderates. So nobody has, and then you have the Republicans in both. So taking those 3 parties together, if there's 3 parties in the Senate, really, there's 3 parties in the House, no one has a majority. So we're at gridlock now. So the implications are more gridlock when, as is all but inevitable, the Republican Party is likely to regain the House easily, and most likely pick up 4 or 5 houses seats in the Senate. So it's likely to be a divided government post the November 8th election, with the Republicans controlling both houses of Congress. It's very early days. Anybody that has a forecast for the midterm elections now is relying, I think, like I am, on history, which suggests that the president's party does very poorly. So I don't think there's a lot of investment implications because, frankly, that's priced into the current market. Gridlock is priced in. Gridlock will result if there's no change. Gridlock will result if there is a change. So it isn't factoring dramatically into our investment thesis right now.
Okay. One other question that's come in is on the slide that you have up on the screen here, it talks about growth and stability assets.
Yeah.
When you talk about stability assets, what are you referring to in that category?
That's a really good question. I should define that for this group in particular. Growth assets include equities, high yield bonds, and emerging market debt, and certain alternatives that have equity-like characteristics. So when you have a 70-30 portfolio, which is benchmarked against a 70% equity and a 30% bond portfolio, To become neutral, you have to assign either growth or stability, or assign effectively equity or fixed income attributes to the alternatives that we're using in the portfolio, which now represent, in a 70-30, over 20%. 20% of the portfolios should be that are in 20% of the portfolios we manage that are in Beacon Pointe strategy portfolios are an alternative investment. So stability assets are bonds outside of the bonds that are risky, private credit, and hedged equity. Those are stability assets. Whereas equities, high yield bonds, emerging market debt, private equity, private real estate, and real assets fit into the category of growth assets. So it's just a way for us to basically group all the assets that we manage on behalf of clients into either assets that are primarily risky, which is growth assets, or primarily used for stability, which are stability assets.
We've gotten a few questions about hedging, specifically around inflation. Precious metals, are they still a good, or what are your thoughts around precious metals for inflationary hedging? And then as a tangent to that, crypto. And is crypto, what are our thoughts around crypto? Is crypto a good inflationary hedge potentially for client portfolios, or how do we think about that?
No, is the answer to crypto being an inflation hedge. It's probably not, it's not a currency, which it has not demonstrated good inflation hedging, which would put it into the stability asset category. It's actually shown more growth asset and equity risk type of features because it's so highly volatile. So no, crypto, well, crypto in general, Bitcoin in particular, I mean, no one knows who the winners and the losers in crypto are. So we've got an actual working group within our team. Julian Frazzo, head of risk, is heading that up, along with our partners in the Denver office, excuse me, that are really interested in understanding and digging in for clients on and articulating, I would think, a more substantial view of crypto for clients. The current view of Beacon Pointe is pretty straightforward. It's a highly risky asset that may or may not achieve your objectives based on its features of what I would call call option on blockchain technology. So crypto is an evolving asset. It's highly volatile. It probably has a place in certain portfolios, but at very low levels, is how I would describe it.
Okay. So quick clarification.
Sorry, Kevin, there was an inflation hedging.
The precious metals.
Precious metals question, which, commodities have the highest elasticity to inflation, but they've done incredibly well lately. So the question is that trade over? It is if you're looking at other inflation hedges like TIPS. For example, we bought TIPS, and I'm just going to use TIPS as a analogy for commodities because the thesis holds true. Commodities actually might do a little better than TIPS going forward in an inflationary environment, but what matters is what's priced in. So if the market's already priced in high inflation and you think inflation might be rolling over, then you want to sell TIPS, which is what we did. Our decision to buy TIPS in the late summer of 2020 was based on the fact that inflation expectations were closer to 1.25%. And that's when you buy TIPS. You sell TIPS when inflation expectations are much higher because the trade's over. It won't do any better if inflation stays high unless inflation expectations rise. And our view is that inflation expectations are likely to moderate with Fed rate hikes, increase in labor force participation rate, and the normalization of the supply chain over the course of 2022. Commodities, same thing, but different. Commodities have exhibited probably the best inflation hedging. We had a natural resources trade on. We still have it on in most of the portfolios, and that's done very well. So commodity hedging, commodities for hedging, inflation hedging purposes work great. But again, in many cases, by the time we're talking about it to clients, we've already maybe, that we're talking about on this call, the time to implement the commodities trade was back in August, September of 2020, when inflation expectations were exceedingly low and commodity prices lower. So now it's not as easy a trade. So we've built into our portfolios real estate assets, which are also a pretty good inflation hedge, natural resources, infrastructure, and TIPS. And some of those trades are coming off because they've run their course, and nobody gets fired for booking a profit in a trade.
Question around some of the things you were talking about with respect to inflation and the equity risk. So if inflation goes below 5%, does the equity risk become lower? And then also related to that, workers returning to the workforce, how does that connect with inflationary concerns moving forward?
Workers returning to the workforce would be disinflationary, clearly. No, because right now wages are rising dramatically, and the Fed's greatest concern is both wages and rents, because those are the permanent prices that get embedded in the economy. And with a higher labor force supply, that is workers returning to work, which we anticipate from our office that it's likely that the labor force participation rate will move grudgingly, perhaps, up to the 63% or plus that we saw pre-COVID. And if that happens, then pressures on wages to increase will decline commensurate with the increase in the reserve army of the unemployed that's sitting on the sidelines waiting to come back to work once they've decided or deemed it's in their best interest to do so. They're still out there. They haven't gone anywhere. So once they realize that working is better than not working, which is possible sometime in 2022, then the labor force participation rate will recover and wages will start to see downward pressure or stabilize at higher levels.
Great.
Now the Fed, by the way, Neil Goldstein is asking if the Fed buys tips. And the answer is yes. So they're not a buyer of tips anymore either. Mostly mortgages, mostly treasury, nominal treasuries, but some mortgages and tips. Okay, I just want to address that.
Yep. No, I think you covered most of the questions. We talked about the emerging markets. There was a specific question around India. I don't know if you have any thoughts around India specifically as it relates to emerging markets. It's China and India typically drive most of that.
No, we don't really recommend individual countries, but given that India has some influence on emerging markets, emergings are really the equity market. Emerging market equities are typically driven by China, Turkey, Russia, Brazil. And for those countries, we're somewhat sanguine about, particularly Russia. Brazil's just can't get out of its own way. Turkey's got a banking crisis that's been brewing, since President Erdogan appointed his son-in-law as central bank president 4 years ago and then fired him like 4 months later. I mean, there's just no continuity of what I would call institutional policy making in some of these countries that had a reputation for it in the past and have reverted to more populist policies. But no, I don't have a strong feeling about individually investing in India for our clients.
Okay. So I think we'll wrap up with any final thoughts from you, and then we'll touch on a few things that we've put out to provide clients with more information. So any final thoughts, Michael?
Well, I would just say that the way we build portfolios at Beacon Point can be summarized perhaps on this chart. We're looking to invest over the long term, and a long-term plan will help clients, I think, absorb some of the short-term volatility. I've said it many times before, I'll say it again. Volatility is the price we pay to build wealth. If it was easy to invest in or easy to take risk when you're supposed to, then everyone would do it. But accepting that you're going to have ups and downs is hard when it's all been up, which it has been mostly up, except for first quarter of 2020, which seems like a distant memory now, given that the equity market's up 90% since then. But we're going to see a cycle. We always do. And in fact, there's probably been a lot of future equity market returns brought forward because of the massive monetary and fiscal policy stimulus. So don't think about going to cash, because a lot of people do. And I wrote a note on this about a month ago. Cash only provides an illusion of safety. The loss of your purchasing power by remaining in cash and the loss of the ability to build wealth by being in cash is real. The safety is illusory. Don't be swayed by it. Identify your objective, build a portfolio to achieve that objective, and make sure your manager is measuring the risk and to keep you staying invested and keep you on track to meet your lifetime and legacy goals. That's what we're doing, and that's what I would encourage others to do as well.
Excellent. So in terms of the final slide here. For those of you that aren't familiar with some of the content that's on our website, I would encourage you check out our website. We've got all kinds of fantastic content, including Michael posts his Markets in Motion podcasts for quick, up-to-date information on what's going on in the market. We also have advisors, Kobe Kress and Karen Reifel from Beacon Pointe, who host the Dollars and Cents podcast, and all kinds of other white papers and content that's available on our website. Again, that's beaconpointe.com. So we really appreciate you joining us today for our macro and markets update. We'll look forward to seeing you in May 2022 for our next macro and markets update. Michael, as always, great job and thank you.
Thanks, Kevin. Thanks, everybody, for joining.